Oh, no. Is it that early?
It is. Bonjour. Good morning, everybody, and welcome to the Gulf Intelligence Daily Energy Markets Forum, where every Sunday we take the opportunity to reflect on where the markets moved week in review and where they travel week ahead. And in that regard, we're joined this morning by our regular commentator, anchor on Sundays, Christof Rühl, Senior Research Scholar at the Center on Global Energy Policy at Columbia University. Good morning, Christof. There's a few things to take away from last week. I suppose on the noisy side was all of the turbulence in the stock markets. Elsewhere, the usual vaccine versus recovery narrative. What did you take out from last week?
Good morning, John. About those two things, but must be the most, well, three things. One, as you said, this vaccine in the vaccine alley, or what we call it, Corona alley, so we are drifting again towards the dark side. It's quite amazing how those who said months ago this will be a very dark winter before it becomes better, how they were right. No? So we just had additional travel restrictions imposed here in Germany, in the UK anyway, affecting the UAE as well. I understand in the UAE too. So there is the severe lockdowns, which show some results, like in France and in Germany, apparently. And then there is the party hangovers from the open Christmas season in Dubai and in the UK, and they don't show any results. And then worrisome are some really bad cases developing in Portugal, where the Germans just sent soldiers there to help them vaccinating because the healthcare system is sort of overwhelmed.
And it's a long time since there was German soldiers sent abroad, I'd say.
Well, yeah, to vaccine and to, I guess, medical units, I don't know. To Portugal, they asked for it. They are really in bad shape, apparently. And coming back to China and all that. So darkness there for hopefully before the light comes. And then the transfer of the digital echo chambers onto the stock markets. That's an interesting one, because I was thinking about this. When you have these organized bets in favor or against something, whether this is actually something which should be or could be punished by regulatory authorities or not. Because if you have an editorial in the Wall Street Journal which says buy GameStop, that's not criminal. But if you have somebody on Reddit saying, guys, let's knock out Game Boy, then that's considered a case for the regulator. So I don't know the answer to that. But certainly, to me, what this is the spillovers of the wall of money, of what the Fed and other central banks are doing, which we discussed last time. These are zillions of people in the rich countries sitting at home, and the savings rates have gone to the sky and they're playing.
And the government is sending them money.
Yeah. And of course we all will pay.
Here's $1,000 to play with.
And then the third thing, which I would, it's that this is, how inflation in this case in the asset market. So you see how kind of money people have, and they will splash it when the corona restrictions are gone, and that will be good for all markets.
Well, I always thought the strangest thing about the subsidy in America was that it was everybody got it. My sister-in-law, who works for a major bank, got a stimulus check in her bank account. It seemed to be without need based.
John, she must have either told you something about her salary, which isn't true, or there was a mistake. I'm getting a salary from Columbia University. I didn't get a check. Only people.
Yeah, but are you American?
It doesn't matter, No, I'm not American, but I'm there in the statistics.
I thought it was just an American thing. Anyway, it seems they gave it to a lot of people.
I think they don't have these passports. I think they do it by tax number, but I don't know.
Oh, right.
So in the end of the day, it's for people below 70,000 per annum.
Oh.
But that's still, the overwhelming majority. And then the third thing I wanted to mention, at least, because I don't know whether it was registered in other outside the US very much, is Biden's White House. They published a big, what they call a fact sheet, like a cheat sheet on climate change, what they're going to do. It's on the White House website. It's an interesting read. It's pretty decisive on the one side, and it has one big thing which I think will backfire on hugely. It's full with these American first and trade restriction proposals. So I had multiple discussions with US people on that, and they say this has to be done for political reasons. This is to get to the Trump electorate and to get the people in the coal towns and win them over. So it is all about American jobs and things being produced in America. And so it has all the potentials of really continuing this kind of trade disputes with China and Europe and others in the field of climate change. So on the one hand, it embraces climate change, thinks we need to have big targets, we need to do something, we rejoin Paris per executive order. On the other, it has this thing around its neck, which will drag it down, I think, sooner rather than in the international discussion.
Welcome, James McCallum, Executive Chairman of Xergy, Professor of Energy at Strathclyde University. James, and happy birthday. We're still counting, as they say. James, one of the notable headlines from last week, I think, was the sort of the return of ExxonMobil. As Arnold Schwarzenegger once said, "I'll be back." The 10,000-pound gorilla of ExxonMobil seemed to make a kind of resurgence last week. No surprise, I suppose.
Well, no, I think it is a surprise. I think the ExxonMobil, of all the super majors, has been the one that has, if you like, remained the most conservative in terms of its energy diversification agenda, and has stayed, if you like, truest to the original mantra of the oil and gas super major. That jump in Exxon's stock, though, Sean, was pretty short-lived. Yes, it got up from their low, obviously, from last March of around $30 up to 50. It's dropped right back now to about 44, and the trend is down, as are all of the super majors towards the tail end of the week. I think, to be honest, there was a bit of a flurry of activity around the stock there, but I don't think it is meaningful. The major oil and gas companies remain in a place where they are genuinely having to work out what their strategy for going forward actually is and how to reinvent their business model. And I don't think ultimately Exxon will be any different to any of the other companies like BP or Shell or Total.
You think that they can? I mean, when you look across the profile of American super majors, we also had Chevron returning, reporting last week, somewhat surprisingly negative figures, but they were indicating how they had held back significantly on their capex investments. At some point, that sort of reduction that we've seen in capex does start to come into the horizon of a higher oil price. Some might argue, and I think Christof has argued in the past, that day never arrives. But ultimately, the cutbacks in capex by these super majors has a significant outlook to their performance going forward.
It does, and those cuts in capex spending, particularly in the area of exploration, are very, very significant indeed. Sort of even in the last year, you've seen many of the major companies cutting back their capex from a year ago, between 30 and 50%. We heard incredible numbers coming out of BP last week. that their exploration spend will be down to about a tenth of what it was at its peak. It's very, very clear when you take a look across, if you like, that basket of super majors. We're now at a position where they broadly were in 2005, except in 2005, exploration and capex and significant project capex was on a rise. Now it's on a fall. So I hear the argument around, if there is a significant lack of investment there, that could potentially lead to an oil price rise. But one cannot ignore in that argument, Sean, that the reality is that we have, for the most part, I believe, entered the era of the low-cost producer. And the reality is that oil prices are continuing to trade in a very narrow range. If you take a look at the forward futures of oil price through 2021, 2022, the prices are down, not by a huge amount. West Texas Intermediate trading down $1 through 2021 futures at 51, but into 2022 at 49. So the reality is that prices are genuinely seen by the markets as going to be softer going forward. I think for me, the statistic which is going unspoken about is the fact that as we continue in this period of fall off in demand and therefore pull back in terms of supply, the world's major oil and gas reservoirs continue to decline. And even as we stand right now, we will need to find somewhere around 25 to 30 million barrels a day of new production to replace what's actually happening in the declination of the actual fields that produce today. So, and the question ultimately out there, which I think you're touching on, is who will deliver that? Will it come from the super majors?
You would think it has to go back to the NOCs, the OPECs, and so forth.
Yes.
Christof, welcome you back in on that point, but also to reflect on the GDP data out of the US last week, down 3.5% for the year, but up 4% in the fourth quarter. I was wondering how you might parse those numbers.
GDP numbers quickly, no big surprise. I mean, the decline and then the recovery a bit less volatile than expected. The IMF in response adjusting its global picture analogously, so a little lower decline forecast for 2020, a little better recovery 2021, but that's all within the range of no surprise, and has to do with the recovery and then the subsequent slowdown in the US now under Biden, and then of course the expected big boom times from the summer. But let me chip in also on the investment gap. So that's an old hobby horse of mine. I would respectfully disagree with some of the things which have been said. Number one, I think the hope for an investment gap and therefore high oil prices somewhere 2021, 22, that's a hope OPEC Plus, so Mr. Bakindo will have in vain as before. Number two, the IOCs, especially the super majors, they are barely 10% or something in that range of global oil supply, if that much. So they are already a minority. It's true that they have cut their capex, but we know that in oil markets, efficiency improvements are swift and large, and that by and large costs follow prices, and that oil companies in calm times make the same rate of return with an oil price of 20 than with 120. That's because costs adjust to oil prices in that system, and quite efficiently so. We have never seen an investment gap, except to my knowledge once, and that was a very different situation after years and years and years of horribly low oil prices in the 90s. The rise of China in the 2000s, that led to a squeeze on investment and subsequently to very high oil prices. But that was a surprising permanent shift in the economic landscape, the rise of China. Nobody had that on the map in the 90s to that extent. We have never seen it after a transitory shock, not after 2014 and the price collapse then, despite all the warnings at that time already of OPEC Plus, what became OPEC Plus and the IEA. And we won't, I think, see it now.
But just on the point that James makes is just to remain standing still on a production capacity point of view, there still requires tens of billions of dollars of investment each year.
Yeah, that's correct. But even standing still, the IOCs are a minority player. That investment is required. Should it not be coming forward, there would be a squeeze. But I don't think companies are actually that short-sighted. And then you have to really make a distinction between, say, Exxon and BP, for example. BP has announced that it will cut its oil and gas production 40% by 2030. Of course, they have a different investment profile from ExxonMobil, which has not announced any of these kind of things. And personally, I think what we see is that oil majors' share price are a pretty good function of the stock market, have been over the last year, 1.5 years. And one has to make an adjustment for these efficiency improvements. So if oil prices from here on are stagnant in the 50s somewhere, then share prices of the oil majors should recover to the extent that they can operate more profitable with a constant oil price. And lastly, oil prices themselves, I mean, we always say a floor, but the fact is there is a ceiling, and it is constituted by shale and others who can come back at prices in the mid-50 ranges. And there's a floor artificially put in by OPEC Plus, and the big question, the big game in town is how long is the floor going to last? Because it seems unlikely that demand is strong enough to shatter the ceiling and to really lift the system in a position, become so strong that it can accommodate shale production plus OPEC Plus production recovery. That seems unlikely.
James, one of the other things that came with the sort of reporting last week by Chevron and Exxon and the big American majors was their boasting or their confidence of maintaining their dividend. which is quite a significant dividend. I think in the case of Exxon, up 7 to 8%. Borrowing to pay dividends, the maintaining of dividends. The Europeans have stepped back from that sacred cow. What's your own sense of how important that is? Can it be sustained? Does it underpin Exxon's raison d'etre going forward? What are your thoughts?
Look, I think Exxon has set its stall out to say that they're going to stay the kind of company that they have been through the decades up to this particular point in time, and they're going to try to maintain their way of going about doing business and operating business as close to that pattern as possible. So no, I don't think the dividend policy is going to be a massive feature in that space. You'll either choose to invest in Exxon or Chevron, indeed, or you won't. And to be fair to Chevron, I think they have also come out and beat the drum of a fairly comprehensive energy diversification agenda. So they're different to Exxon. Exxon remains, if you like, that one company that has stayed out there as a very traditional upstream, downstream oil and gas company. I would, if I may, just like to pick up on something that Christof said there around the business efficiency of operators. We have never before seen such a wholesale erosion in terms of the talent base that actually the big oil and gas companies have had in terms of employees. Last week we read of, to put a number on it, just BP, shrinking from 700 exploration geoscientists at the core of their decision making around where they would actually put new wells, down to 100. Now, those people are leaving leaving BP. Most of them will almost certainly leave the industry. And so historically, Christof is right that companies, when they readjust their costs, et cetera, they've been able to bounce back as oil prices have bounced back. But if we are genuinely going to trade in a relatively narrow range of oil price going forward, I don't think it will be the super majors that move into that space. We will continue the trend that we've seen over the last decade of the emergence of the much smaller independent oil and gas companies, whose very structure is geared to actually delivering field developments at a lower price point and at a lower profit margin, which comes back to your point around dividends. That's not been a part of their business strategy. It's not been a part of their business policy. And I think we'll see an expansion of that community of producers.
That I agree completely. With that, I agree completely. And that fits into this picture. What we are going to see as demand slows and then stagnates over the next few years is exactly sort of really a race to the bottom in the end between low-cost producers on one side who have this cost advantage and in a shrinking market will start fighting each other, and the nimble ones who can compete, who stand up, who are able to fill niches, of which the shale producers were sort of the best example we've had. I agree completely with that.
Mm-hmm.
Christof, just in looking forward, I mean, the things that are kind of impacting the oil price or what could in terms of market direction, there has been a lot of correlation between the sentiment of the financial markets and the oil markets moving in the same direction. Does this turbulence in the equity markets have a consequence for the oil markets, do you think? And how do you see that playing out in the coming week?
Well, you see in times of crisis and huge changes, everything becomes correlated. That's what people mean when they say risk on, risk off. Everything moves up and down together. And it has clear signs if it moves in the opposite direction, like gold or the US dollar. So that's one thing. Having said that, as times calm down, you would expect to see a divorce. Historically, you would think a very high oil price is bad for the economy and vice versa. That becomes increasing. That borderline becomes increasing. The interesting, this is a really big question. What does this mean? This kind of behavior in stock markets we have seen it. I think what it means, obviously, is sort of the spillover of social media into yet another big of our life, which we thought was sheltered from that. It's built into politics, it's built into culture and social discussions first. Now it's spilling into markets. But is it something which needs to be reined in? I mean, aren't we living in a world where you have cold-hearted investment bankers doing shorts and they should better know that these things are risky? Or is that something which needs to be stopped? Because we could easily see a rampage of somebody swinging himself up to become the leader of the pack and coming up with some crazy prediction, and then markets being completely distorted. I think that markets are markets because they should operate freely within a framework. I'm trying to make up my mind whether making a deal on Reddit and saying let's attack this company, whether that is something different from you writing editorial and say buy oil and everybody goes and buys oil. If it's not, then I tend to think they should be left alone and they should play itself out, and then it's probably the only way to arbitrage this away, to provide these waves from being really high and distortive, is to let it go, and then you see the speculation peter out. To answer your question directly, there was already a smallish stock of some oil company in the US which improved by like from 0 to I don't know how many percent. It's had a big price spike following the same scheme. Somebody said, "Oh, buy these guys," and then they bought these guys.
Well, it's clearly, I suppose,
ultimately too, and went back down. So at the end, they always lose out. I mean,
ultimately, this is a market that many will forecast is currently in frothy bubble territory, and all of the things, as the classic sort of story from the 1929 crash. Once your shoe shine boy is telling you to buy a stock, it's time to get out as fast as you can. Let's go to the room for their views on this in terms of where the outlook is and the on the equity markets. Survey question for today addressing that point. Wall Street ends worst week since October amid trading frenzy. Will the main stock market benchmarks be higher or lower at the end of Q1 than where they started the year? Not where they are today, but from the start of the year to the end of Q1, will equity markets be lower or higher? And that is a question and an answer that seems to be, if you'd asked a week ago, I think this answer would have been a certain way. Now, I think the answer is a little bit different. James, looking ahead to the week, one of the other issues that plays in our thoughts a bit is the rising of new supply, higher cost supply. We've seen yet again on the Baker Hughes rig count, the US rigs back up, keep climbing every week now, month after month. Your thoughts on that and its outlook?
So I've got to go back and pull back a little bit on the emphasis of those adjectives there, Sean. Yes, climbing higher, but tiny footholds. The reality is these are very small incremental change in terms of the rig count.
But inevitably, after 6 months, every week's a dozen or more.
Yeah, I mean, you'll have heard me say before. I mean, these are rigs basically being engaged in recompletion work or workover work on existing wells.
Production is also
which can bring production
already. Production increased 1 million already. Sorry for interrupting.
Yeah, but that's no problem. Christof, but that's back from last November. But if you're sitting in a situation
10%.
where, but if you think the oil prices aren't going to go any stronger right now, and you are sitting in a situation where the financial markets are getting less and less confident about their ability to support you going forward, what do? You bring your wells on stream, you produce that oil, and you get some money into your coffers. And I think that's actually what's happening there. For me, we will continue to see a longer term decline in the amount of shale oil unless something materially happens going forward to change oil price. We will not see that continued trend of increase coming from anything other than remedial workover activity. So that's what that actually is. The other thing I would just say, Sean, if I may, just pick up on this point about the stock market over the course of the last week, which you're going to get, I guess, the feedback from the audience in a second. It's important, I think, to note that the stock market turmoil was, as Christof pointed out, in a very narrow type of trading space. In terms of going after, if you like, the traders who were involved in shorting the actual market. And for me, that what we saw last week was not so much an indicator of increased volatility in the markets, because the markets continue to trade in a very narrow spectrum of trade volume and cash coming into it, with lots and lots and lots of cash, and presumably when Biden puts another 1.9 trillion into the US market, even more cash sitting in savings or sitting on the fence, however you want to look at that. What we saw last week was an indicator of a growing level of social disruption that's out there, which, as Christof said, moved over and into the markets, or as was widely reported in some articles, evidence of society sticking it to the man.
Yeah, but it's not happening in a vacuum. I mean, this is a moment in which a vacuum in the sense that it's happened. The events of that last week are happening at a time in which the equity markets are at an incredibly elevated level, unsustained by normal parameters of forward earnings and so forth. So in that regard, there was an exposure, a vulnerability perhaps for that kind of impact.
There is a vulnerability.
Sorry, James, just finish off your point.
No, I was just going to say that I can see where you're coming from, but it's worth stating that if you take aside the COVID pandemic, which of course is meteoric in its effect, but if you were able to put that to one side, prior to going into the COVID situation, the United States markets were on an 11-year bull run. If we take a look at the Chinese markets outside of COVID we're on a sustained bull run. Now, if we get to the end, or we get COVID in our rearview mirror, and quite frankly, I think the last week has shown that whilst we may have been seeing a little bit of light at the end of the tunnel, we're definitely not a couple of steps from coming out of the tunnel. We're still deep in the tunnel, and we've still got a ways to go here. But if we get to a point where COVID-19 is, as I say, in our rearview mirror, then what is to stop those markets coming back into resuming the bull run, which they were already on prior to going into the pandemic? And I think that is the sentiment which has held the markets up. Well,
I suppose that's technically the idea that this is a new bull run because the markets dropped more than 20%. I mean, it's technical definition, but Christof, giving you the last word, let's just get the survey answer first as to where we're at with the room's view. 52% lower. Christof, your thoughts and closing comments?
I think I would take issue when you describe this as a sort of mindless bull market. I think, number one, we have to look at the details of it a little bit. Then you see tech stocks are completely overvalued. But what we just discussed, energy, other value stocks, they're not necessarily overvalued compared to earnings. What has happened as a result of the crisis was a shift within the market. And yes, that will readjust at some point, but that's not necessarily saying that the whole thing is overvalued. And I agree again with James, I'm surprised, but what happened around the small investors, that's a spillover from the wall of money hitting the market. So that's a big scheme of things, a small item. What is really important is that this is a 10, 11-year-old bull market, and what drives in it. What has driven it is an asymmetric central bank policy, always quick to lower interest rates when there was any problem or threat of a problem on the horizon, always unwilling to do the opposite and raise them when the situation was threatening to overheat. Once they tried, and immediately the market wobbled and the house almost came down, I think in 2013. Otherwise, for a decade or so, we have seen this policy. And so the market is a function of that policy, not the other way around. And at some point, the bill will come. And if the bill doesn't come from the Fed and it doesn't look like it, then it will come from creating inflation, because you will have inflation, people will stop buying bonds, bond prices go down, and that means interest rates go up. And then you will see the debt bubble, what they used to call deflate. And that is going to be very nasty, and it will happen. The only question is, will next year, or who knows? Nobody knows. But
or next week, perhaps.
One last thing I want to draw attention to. There is now a bunch of economists who are sort of getting nervous about this, who were ardent advocates of more stimulus so far, most notably Larry Summers, who's a big advisor of Biden, who went public and said, look, guys, these payments, stimulus payments, are more than compensating for the decline in wages and the decline in GDP COVID cost, and they're more than compensating by multiple. And this is dangerous for inflationary reasons. And so one of the things to watch out over the next weeks is whether the Biden administration will actually walk back from this demand of the $1.9 trillion stimulus. If they do, this may be an easy thing to misread by markets and cause some wobbles. temporarily at least. And it looks like they may.
Well, it's certainly enough in the ongoing events in terms of the equity markets for it to have ramifications for the confidence in the real economy, and hence the impact on oil prices, and where those correlations have been, all boats rising, all boats falling. And again, the US politics, the drama in the Senate, the trial of Trump coming up for next week's, or the week from Monday. For if you haven't had enough Trump entertainment, this guy just is like the bad penny that won't go away, and he lingers over other and so much. So see what implications that has. But for now, James, thank you so much for joining us this Sunday and for your insights. And as always, Christof, thank you for your insights today, and for the outlook going ahead. For everybody, have a safe and productive week, and we'll catch you all in the coming days. All the best.
All the best. Thank you, Sean. Thank you, Christof.
Bye-bye. Yeah, thanks both.